The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years. COVID-19 still raging throughout the planet. And the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, May 12th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you're here with us tonight. The endless enigma that is the market pullback, the bear market, the crash, all the things that the media is telling you, you're not going to hear that from me tonight. I'm going to recognize that the market is in a downturn, but this endless enigma of corporate media chaos is not going to be perpetuated by this broadcaster. I'm going to talk about the earnings reports, some delights, some surprises, and other news. Those of you that know the program know that we cover a variety of topics. I have, 23 to 24 sources that I follow every single day. So I use these sources to compile these programs as well as trade your portfolios for those of you that are online that are clients. And then I summarize it every month, usually the Thursday after the unemployment report, because that used to be big data. And of course, now it's kind of second to a lot of other things that are happening geopolitically and with inflation. The number one concern in the markets right now is inflation, but the number two is the war. We'll get right to that. If you are new to the program, please subscribe to us on YouTube. Click the little bell and you'll get updates whenever I go live, or I post one of the CB3 Live updates intra-month. If you're not following me on Twitter, you should be, because I tweet every single day. We have a pretty big audience there. Also tweeting to Facebook, the CB3 Live Facebook page, and LinkedIn. So we'll hope that you join us there as well and ask questions. I dialogue with you guys when you send me questions there on social media. So this guy right here is the next Hitler, and that's why I put the pictures together. The worst tyrant in our lifetime. This map is updated. About 20% of Ukraine now is under Russian control. You can look at the map and see the dark areas are where the Russians either are advancing or they have complete control over the infrastructure there. And why is this happening? What does Russia want? Well, you'll need to go back and watch the February, March, and April issues of this program to get a lot more detail if you were interested. But here's what it boils down to. Grains, meaning soybean, corn, and oats, and oil and natural gas. These are the pipelines that go through Ukraine from Russia, feeding Europe. And since this war began, what you are seeing is the European Union deciding, you know what, we've been too dependent on Russian oil. Duh. Kind of wondering why it took you so long to figure that out. But little by little, Ukraine is saying, we're not going to continue to let these pipelines flow from Russia, especially as Russia is not just saying they want to take over territory. They're killing thousands of innocent citizens and even bombing citizens as they try to escape through to Poland, Romania, and other places. So this is what's at stake. Basically, Russia is trying to reclaim their glory days, which ended in 1991 when the Soviet Union fell apart. Now, the support that's coming to Ukraine is coming from many different countries, but you can see far and away the humanitarian and military aid that they're getting is coming from us. You can say it's coming from NATO, but let's face it, we are mostly NATO, at least preponderantly when it comes to military arms and certainly to the technology behind them. So the reason we don't need to give to them financially, at least that's the government's, the administration's point of view, is because of the sanctions that the United States has put in place, and it's pretty extensive. Basically, half of Russia's banking assets have been frozen. Many wealthy Russians have had boats, yachts, I should say, absconded. And I've even heard that it's gotten to Vladimir Putin's personal assets. Of course, it's really tough to get information from Russia as to what is under duress financially in their country. But the reality is that we're expecting to see at least a 15% drop in the Russian economy this year. And the longer the war goes on, the worse it's going to be. Now, obviously, there's a humanitarian component to this war, but since I've covered that pretty extensively the last 2 months, I'm sticking to the financial issues here. This is one of the issues that is rubbing market participants the wrong way. The longer this goes on, the more hatred that's built up for this man, this dictator who is single-handedly causing this chaos. It just brings emotional angst to the market, which when you add to the number one thing that's bugging the markets makes a problem. So how does this work out? So many people are thinking that there'll be something like a Marshall Plan for Ukraine when this is all over. This happened during, or I should say after World War II, basically a U.S.-sponsored plan that was designed to rehabilitate the economies of seven Western and Southern European countries because that's how widespread the damage was during World War II. Program basically designed to create stable conditions and increase the number of democratic institutions. Obviously, being the largest and most significant democratic institution in the world, we would like to encourage other democracies. One of the reasons why we went into Iraq many years ago. That didn't work, but we at least tried. So the point of this is, that's what the outcome is going to be here. You're already seeing, if you follow the news, that Finland has expressed interest, that they definitely want to join NATO. Sweden will follow them. I believe when all this shakes out, you will see Ukraine as well. It may take a couple years, but not all the people watching this program may agree with that, but that's where I think it's headed. So here's the number one reason why there is so much anxiety, why the VIX, which is the volatility index, just continues to stay in the 30s. and that's inflation. So you might think, well, it's worse here than anywhere in the world. That's not the case. Look at Turkey, Argentina, Spain, Netherlands, Chile, Russia. All over the globe, there are inflation problems. We are seeing about an 8.1 annual inflation rate right now. I think that is at its peak, and I'll tell you why in just a moment. This is what it looks like on a chart. So I need you to understand there's two ways that inflation is quoted. It's quoted as core inflation and then excluding food and energy. Well, you might say, well, why would we ever exclude food and energy? They're the most expensive items on there. Well, not necessarily, but they are the most volatile. So many agencies that, especially the U.S. government, Bureau of Labor Statistics, and the Labor Department that rate these statistics always show both. They'll show the all items, which is that 8.3 that you can see on the graph, and then the lower number, which is excluding food and energy. Once food costs get under control, and that would include baby formula, for those of you that have seen that in the news, and energy, and the only way the energy situation is going to get under control is if we have different policies at the federal level, which we'll get to in the political section. But that's why you're seeing this spike. Note that every spike does return to a norm, and that's in the 2 to 2.5% range. Why do I think that's the case? You'll see in just a second. It's not just goods and services, but wage inflation. So this goes back to 2010. And you can see a steady increase in wages. I mean, that's what we need to be able to keep up with inflation. But you'll see in the last 12 to 15 months here on this chart, a spike. It's not the only time there's a spike on this chart, okay? There was a pretty good spike between 19 and 20, and then it flatlined, and now it's spiking again. And that's simply because there is so much demand for workers. I'm 67 and I have never seen so much worker parity. We even have a situation in our family where there was 3 different companies looking for a position for one of our family members. It went on for 3 weeks and it's extremely highly competitive. And we're seeing this all over America, not just locally in our family here. So crude oil, and that translates into gasoline, is the biggest concern. I filled up yesterday and I didn't quite hit $100 on my tank, but I was paying $5.47 a gallon in Tennessee. Now, for those of you in California that add on the taxes there, you got to be at a 7 handle, I'm sure. I would think that that would upset you, okay? And that is one of the biggest causes or inputs into the inflation crisis in America right now. You can see once the Russia war starts, that jiggly line. That same thing happened in 1991 when Iraq invaded Kuwait. Because the crude oil supply, of course, we were so dependent on the Middle East back then that it definitely rocked the markets. Not so much this time. Why? The previous administration had us in a position of energy independence. That has been weakened somewhat in the last 18 months. We'll see if that returns to dominance, but that's definitely meaning gasoline is affecting inflation. So the bad news is that in April, for the second month in a row, inflation clocked in above 8%. Remember the inflation, that's including energy and food in this case, okay? But the good news is sometime, that's the operative word on this screen, in the next 12 months, it will very likely fall to around half that. So take a good look at this chart, okay? And you will see once we get to 2023, not 2024 or 2025. 2023 is only 6 months away. We'll call it 7, okay? And you can see we're down in the 2.5%, 2% range. That's the Fed's target. That is the Fed's target. You won't see this data on the corporate media because then you would go, oh, okay, well, I can hang in there for 6 months. That's why I'm showing it to you. Oh, okay, you can hang in there for 6 months. Is there a guarantee that's going to be 2.5 by December? No. Is it virtually a lock that it will be by this time next year? I think so, based on my study of economics, okay? You're seeing already a drop. Look, the peak of this core inflation, CPI, Consumer Price Index, okay? So it's slightly different than core inflation. Maxed out in the early part of 2021. This red line is the most recent reading, which is Tuesday, just 2 days ago. All right, so it's heading down. but the numbers are still high. Look back in 2015, 2016, it was hardly moving at all. So the rate of change of CPI is dropping. That's what we need to see. Okay. One of the people I follow is this Justin Lahart. If you're interested, you can do a search for him on, you guessed it, Twitter. And he said inflation may have peaked, but it isn't the same thing as saying it's under control. And that is correct. I think that Jay Powell just yesterday was reappointed as the chairman of the Federal Reserve. It took 3 months to get that vote in. I'm not sure why, but it did. He wants to keep his legacy. And his legacy is either going to be one of success or one of GOAT. And I don't mean the greatest of all time. I mean GOAT, like out in the fields, you know. And how he handles this inflation debacle is going to prove his legacy. And I think he's going to get it under control. So those are the two big influences in what made this month's market review. Okay. NASDAQ, bad month. No doubt about it. April at down minus 13.4. Really, really bad. Okay. It's the second worst start in the first 138 days of a year in the history of the S&P 500. So when you are a money manager, you invest with probabilities. We don't expect, and we can't invest for what we call black swan events, one in a 2 million event or one in even a 500,000 event. This is second worst day in S&P history. In fact, it's only been up 43% of the year the S&P has, the fewest number of days since 1974. What does that mean? The probabilities are that the end of this downturn are near. I realize that that doesn't lessen the pain when you go online. If you're going to go online and look at your accounts every day, I do not suggest that you do that. If you want to do that and you want to talk about it, I'm here. I turn on my psychological hat, my psychiatrist hat, and I'm happy to talk to you. That's mostly what it's been this year. I've been through this 35 plus years, guys. There's really nothing different of what's happening now than what has been before. It's recency bias. And I have heard from a couple of you, but you're tired of hearing that, but I can't help it. That's what's going on. If you look at the last 5 days that have all been down in the market, although today made a pretty heroic move to come to unchanged when it was down, 200 or more than that, 300 in the Dow, and about 50 in the S&P and a couple hundred in the NASDAQ. Closing unchanged, pretty big deal. So we are at the sentiment. This is sentiment now. So this is not quantitative. This isn't like 1%, 3%. This is a meter that takes a bunch of psychological inputs with one of the many sources that I use, W Street, great company, and they track fear. There's still room to go here. So on March 23rd, 2020, that was the low of the previous bear market. That was at the height of the pandemic, really just the beginning of the pandemic, okay? In March of 2020, the needle was slammed all the way to the bottom. We're not there yet. Now, it doesn't have to go there. This indicator, the VIX, the fear index does not have to go there, but I am already seeing signs just this week in esoteric things like the put-call ratio, options trading, etc., where the sellers are getting exhausted. Markets bottom when the last seller has sold, the very last one, because if there are no more sellers, what is there? Only buyers. That's correct. Which would reflect the opposite on January 2nd of this year when there were no more buyers. Not a single one. There were just sellers. And that's where we are now. It's just that this downturn, you're thinking, this is recency bias. You're thinking back to 2 years ago. Well, that's what a bear market should be. It should go down for 5 weeks and then turn around. No. Go back to 2008 and 2009. Go back to 2000 and 2001. It takes more time than that most of the time. Okay. This stings. I get it, especially considering the stellar annual returns of the past 2 years. I have clients that have said, man, you did 63% in 2020 and you're just stinking. And yeah, you're right. I mean, Kathy Wood is down 78% from the lifetime high of her ARK program, ARKK, if you want to check the ticker symbol. But going back to 1928, there have been more than 90 occasions when the S&P has declined by 10% or more, and we're more than that now. Okay, that's basically one every single year. Not quite, but we'll call it 0.93%. All right. Even bigger declines are not that rare. Okay, not at all. And this is what it looks like. Market pullbacks are simply part of investing based on U.S. history. And this isn't taking foreign markets into account. Down 10% every 11 to 12 months, down 20% every 4 years. And you might say, well, we're down more than 20% in the NASDAQ. And it was just 2 years ago. Okay, I'm putting an asterisk by the pandemic. That's a once every 100 years event. And of course, the market recovered very quickly because it was a healthcare driven bear market, not a financial driven bear market. This is a financially driven bear market because COVID is mostly behind us. Down about 30% every 10 years. All right. And actually, the NASDAQ was down more than 30% just 2 years ago. So again, that's an anomaly. But just realize, what's the takeaway? This is normal market behavior. I know I've been saying that, but I have to keep saying it. This chart, you guys have seen many, many times. The red areas are secular bear markets. The blue lines with the black squiggly dots and movements there are secular bull markets. A cyclical bull or a cyclical bear happens within these larger time frames. This is 100 years of data, 100 years. We are in a secular, let's try this again, it's tough. Cyclical bear market. You can see, look at the top where the blue arrow is. It's just ticking down there, guys. If you look in the middle where it says secular bull average 15.41, I don't have the year on here, but that was 1987. Market dropped 21% in one day on October 19th, 1987. And that started a cyclical bear market within a secular bull market. Okay? This is what's going on now. This is what's going on. I know it feels like Armageddon and the end of the world. It is not. Every once in a while, when we get to May, I have people say, I've always heard you're supposed to sell in May and go away. Okay, so here are from 1950, and this is courtesy of Earnings Beats, Tom Bowley. Thank you, Tom. The average monthly returns for every month since 1950. Now, in yellow are the months that are May through October. How many do you see that are negative? That would be one. All right. Do you want to miss out on that return in July or the return in October? Are these guaranteed every month? Of course not. But we don't know when these things are going to happen. And in fact, in 2020, if you had gone away in May, you would have missed an enormous recovery. Go back and look at the charts or call me and I'll send them to you. All right. It's just not a solid strategy. All right. Probabilities of stock market gains. Now, this is for a couple people that have called and said, you know what? I've decided I'm going to retire earlier. I'm going to be quitting work in 3 years, and that's why I'm so scared. Okay, I get that. So let's start on the far right, not the green, but the far right. If you've got a 15-year time frame, you don't need this money for 15 years. There's a 100% chance it's going to be profitable based on 150 years of data back to basically the Civil War. If you got a 10-year time frame, there's a 92% possibility. If you have a 5-year time frame, 83%. A 3-year time frame is at 84%. So if you're retiring in 3 years, there's an 84% probability that you're going to have gains in your account. It drops to 74 for 1 year. So should you be lightening up in your aggressiveness? And yes, perhaps you should. That's a discussion that's going to have to be done not live. And if you ask me on camera, I'll give you a general answer. But if you're a client and you have specific questions about your portfolio, and I'll go through each of our portfolios and their performance as I do every time I do a show in just a few slides from now. Okay. Market timing can be costly. Now, I put this slide up in a different variation the last 2 months. I'm showing basically the same data, but I'm just doing it in graph form. So if you invest $1,000 in 1990 through 2021, and you just keep it invested, you have an average annual return of 9.9%. Okay? Indexed annualized performance. All right? If you miss the best day during that whole time, that drops to 6%. That's how big an influence is one of these monster up days can be. And what causes a monster update? The lack of sellers. Why are there sellers? Why are there no sellers? Because if the last person is sold in a panic, and they're not selling at the top, they're selling at the bottom because it's an emotional decision. You miss one of these 12.5% days, go back and look at the charts. They happen. Don't let recency bias fool you. You've seen 12.5% down days, and you probably remember those psychologically, but we also have them to the upside. So you miss that one day, and you're down to 6%. Miss the two best days, and you're at 3% a year. Miss those two best days, miss the three best days, and you're flat. And you're flat. And then it just gets worse from there if you miss the next best days. Now, you might say, well, what I want to do is miss the real bad days. Wouldn't that offset that? It absolutely would. And if you could give me a roadmap on that, yeah, it would be easy. It would be easy. But we simply don't know what's in front of us. I've thought about not using this example because some of you may flinch at this. But I was watching the astronauts on January 28th, 1986, I think. Come out all smiling, everything. They got into the Challenger, and we know what happened. But 90 minutes before they took off, everything was upbeat. They did not know what was in the future. Okay? I don't know what's in the future for the market. I do know by looking at charts for 100 years, certainly super rock solid data from the 1950s, that the market goes up most of the time. So standing aside and waiting until you feel comfortable is not a good strategy for investing. Okay? We do make allocation changes. We don't just sit here and get whacked in stocks that are underperforming. We will rotate into other stocks. But as long as we remain in a secular bull market, our programs will stay 99% invested until such time as it is clearly evident to me that the secular bull market has run its course. The average time frame from the chart a few slides ago, 20 years. We're halfway through that. I think this is going to 2031, 2032, 2033, sometime in that range. I'll know more once we cross the next decade, okay? So I said I wanted to talk about earnings. You guys have seen this chart many, many times. If you remember from watching the show, this number where it says S&P 500 above 79%, the average is 73%. Now, we've had some quarters since the pandemic started where we've been in the 80s, which are just stellar. We're, quote, down to 79% now. This is still strong. Look at the highlight in the industrials. 90% of the companies reporting. And again, we've only got 66 stocks left to report. 434 of the S&P have reported. And obviously there are other stocks in the NASDAQ and the Russell, et cetera. But this is the backbone of what's analyzed in the American stock market. Technology, 85%. These are good numbers. Now, what you're seeing, because the market looks so far into the future, at least 6, sometimes 12 months into the future, is that the second quarter earnings, the current quarter we're in right now, which starts to report on July 1st, may not be as strong, maybe not at all as strong. We won't know until July 9th gets here when Alcoa and all the banks start reporting. All right. But for right now, the earnings are still strong. They won't tell you this in the media because they want to keep your eyeballs on the screen, and they do that with fear. All right. This is where I pause to get a drink. And so it's a tough time. But a couple things I want to point out. CB3 strategic growth has overtaken capital growth. Strategic growth, even though it's a little more aggressive than capital growth, I think I took a little bit more conservative stance 2 quarters ago. And so the 3-year results, obviously the 1-year result are very, very similar, both down about 21%. But the 3-year results are stronger now with strategic growth. Those are the aggressive growth programs. Now look at the last 9. And this is something I said I would address when I got to this slide. For those of you that are in our aggressive programs because you're wanting to grow your accounts, if your time frame has changed, and you're concerned that you're going to be working 3 years instead of 6 years, probably don't want to both be in, or you don't want to solely be in capital growth or strategic growth. As you well know, I trade all 4 programs. Many of my clients trade all 4 programs. Growth and income is negative, but look at the return for the year, minus 9.5 versus the NASDAQ at 26.6. So our call on conservative stocks and ETFs has worked. The 1-year performance down 6%, whereas the S&P down 4, Dow Jones 6.9, NASDAQ 10. I'll take that. So should you just stop everything and call me tomorrow and put everything in growth and income? I do not recommend that. Okay. Why? Because you're going to need CG and SG to pull you up by the bootstrings when growth stocks come back in favor. Again, Kathy Wood, who's one of the most well-known hedge fund or ETF managers in the country, is down 78% in her main program. She just keeps doubling down. I'm not doing that. Okay. I definitely have conservatized. But at some point, as retirement gets closer, GI is probably where you want to be. It's weathering these downturns. It did the same thing in 2020. All right. So I'm going to leave this on the screen and get a sip of water, and I'm going to go into the chat while I'm getting a drink. Hope you guys are doing well. At least winter's gone, huh? Hey, Martha, how are you? The mitten is covered, okay? Hey, Hossein, how are you? Curious how Russia keeps the ruble afloat. Well, of course, good question, Andre. Putin said, everybody's going to start paying for oil in the ruble, and most people ignored that. I think there's still some backdoor transactions going on. Certainly Hungary, which is a NATO country, is doing everything they can to keep their friendship with Putin. Certainly China is probably paying in rubles because they can afford to do that. But sooner or later, when the demand dries up, no pun intended, for Russian oil and natural gas, it won't matter what they can do to keep the ruble going because there's not going to be any income. Russia is very much dependent on energy exporting. Okay, good question. Just read Atlanta's number 2 in the country for highest inflation, over 10%. Doesn't surprise me. Thanks for that, Nellie. And Keith, hey, how are you? Cost of gas here, $3.64. That must be regular because for premium, $5.60 something. Man alive. Why does it appears that gas prices are rising daily, but barrels are selling for $108, $110? Because the gas companies are the people that provide gasoline. Exxon, it was a good example. Chevron and the smaller vendors are not required to drop prices. They'll continue to charge what the market will bear. The only thing that gets prices to drop is when the gas station across the street says, why don't we lower it 2 cents and see if we can get more business here. You can use crude oil, but I would say that gasoline prices are a lagging indicator because once they get high, the local gas station dealer guy, that their margins are so tiny anyway. If they can get a 6 cent margin on a gallon of gas instead of 1.5 cents, they're gonna take it. So refuse to look at my account. I read an article about that today, that there's just nothing good for your mental health. That's what I do every day. And believe me, it's not easy. Hey, Tommy, good to see you. Gas in upstate New York, $4.50. Yeah, thanks, Doc. 87 grade. Yeah, that's not high. That's not premium. 93 is premium, but yeah, I get it. It's Thomas. Don't look at my accounts either. Guys, you're going to be fine. You're going to be fine. I look at them. I look at mine. I'm with you. You guys know those that are clients of mine. I'm trading the same programs you're trading, the exact same programs in different weightings probably, but good to see me drinking water. That's my trainer online. So that's one of the things that's keeping me going, guys, is working out 3 to 4 days a week, helping my mental state. So that's my plug. If you're not doing something to keep yourself physically in shape, whether it's the job market, inflation, or having to open your account statements, that's what I would recommend. So I think that's all the questions. Keep them coming, guys, and I will go forward. So just realize I've been showing this graph since January because the high for the year was January 4th. And You just got to lower your expectations. You can go back to the March episode and see what the trailing 2-year returns were for all these markets. And we can't do this year after year after year. Okay. If we somehow end this year flat, that is a huge victory. Just like today, when you're down 200 in the NASDAQ and you close down like 2, that's a victory, guys. Nothing wrong with a flat year in the market if we can get back to that, so. All right, so I was going to use a different word, but I decided to use this one. If you allow the jackals to spook you out of the market at this point, they will devour the stocks you sell. And later, when you are comfortable, I used that word earlier, you'll buy them back at much higher prices. That's the history of the stock market and has worked over and over and over and over again. For 150 plus years. You just have to trust me on this, guys. I'll send you the data if you don't trust me, okay? In the world economy, employment scenario, this is the data from last Friday. Number of job openings continues to exceed the number of unemployed people seeking work. I've never seen this extreme in my lifetime. It's just astounding. 1.8 jobs for every one person. It's just nuts. It's nuts, okay? Nearly 2, 1.8, all right? So people are quitting, okay? And I know this for a fact, that when you have a skill set that is in high demand, multiple job offers at the same time, hear about people taking a job because they're trying to hold that down until they get an offer 3 days later, and then they take that job, cancel the first one, and then another job offer comes in and they've got 3 different recruiters calling them. This is real life, guys. I'm seeing this up close. Okay. I think it's healthy. Why? Even though I am an employer, and I've employed, dozens of people in my lifetime, I am glad to see worker parity getting closer in this country. That's healthy for the economy. It's healthy for society to be shrinking that gap between the very rich and the workers. I mean, there's worker pricing power now, and I hope it stays. I really do. I think it's a great thing. We're seeing small businesses last month, shredding employees, but larger companies are basically stealing them. I mean, sorry. Let me take that again. Large companies are going, if we want to have talent to compete with the other trillion-dollar companies in America, and soon there will be a couple dozen of them, okay? I believe. They're only just a handful now. And yeah, as a sidebar, I'm sorry, this is just me venting. This whole thing about the Saudi Arabian oil company passing Apple and Bloomberg, just as I was getting ready to go on the air here, this must be a change of the guard. No, it's not a change of the guard, you knuckleheads. Energy is super high because of inflation, so that's why this oil producer in Saudi Arabia is doing great. Only 2% of their stock floats as opposed to 88% of Apple's floats. Anyway, sorry for the rant, but Apple is doing just fine, as well are the other trillion-dollar companies, and that's why they're hiring. That's what's on the screen here. So large companies, 321,000 new jobs in April. That's a great sign. The unemployment rate continues to drop. We are within a couple decimal points of where things were before the pandemic. So much for thinking that it was all Donald Trump or all Joe Biden. It really has nothing to do with either. It has to do with this market in America producing so much opportunity, and really that's the essence of what we are here as Americans, is opportunity, that the unemployment rate just continues to drop. It just continues to drop, and job openings continue to rise. So you're going to hear the recession calls. I'm not going to play into them to now, but look at this chart. There's obviously you can go back much farther, but we're just looking back at the most recent recession. This happened, of course, because of the COVID pandemic. Notice that employment goes down. And I guarantee you, if you go back 50 years, every time there's a recession, people are losing jobs. How can we have a recession now with this many job openings? Okay? Don't listen to the media. There's just no data to support it. I've been doing this now 17 months, this program. And I'm trying to show you the data that's real. This is from the Labor Department via the St. Louis Fed. Whether you're from the right or from the left, it's government data. And I believe it because I get enough other private data. I don't have time to show you 300 slides every program, okay? But we are not heading into a recession. COVID winding down, and the only thing I have is this blithering chart. You can't read it, but I just put this here because you can go to this website, and it's Johns Hopkins, of course. And if you want the URL, I'll send it to you. But if you want to see the whole world, the number of deaths, the number of new cases, the red dots on what's exploding, where the Omicron variant is, et cetera, it's all there. But I'm really trying to wind down my coverage on COVID. It's a horrible pandemic. It was a horrible pandemic. It's more an endemic now. It has still not exceeded the carnage of the 1918 flu, but obviously it's affected the world economy. And I think now we are in an aftermath stage. So as I report on COVID, now it'll be more in an economic sense. Obviously, if you lost someone, most all of us know someone that lost someone, if it wasn't a family member or friend. Terrible, terrible thing. But in a financial sense, it's going to affect the world for decades, in my opinion. Okay. The reason I cover politics is because politics leads to policy, and policy has a portfolio impact, and portfolio impact has an impact on your personal life. I'm debated about covering this next topic, but I need to do it. Roe versus Wade, the leaked draft. You might say, what does this have to do with finance? And my answer would be that in the surveys that I'm seeing that people are upset about, that have them anxious about life. And when people are anxious, they don't spend money. When they don't spend money, companies don't have income. When companies don't have income, they can't produce earnings. When they're not producing earnings, stock prices go down. So yes, this is a financial matter. It's third right now. It may drop off the radar next month once the court actually releases their statement. But what I am going to suggest to you, because I talked to 3 people that did not understand what this Roe versus Wade SCOTUS decision is. The 10th Amendment to the U.S. Constitution states that any issue not delegated in the Constitution is to be decided by the individual states. Okay, so if you're on the right, you're probably not going to like the answer I have here. And if you're on the left, you're probably not going to like the answer either. This is not so much an issue about pro-life or pro-choice. It is a Federalist versus anti-Federalist issue. John Adams, second president of the United States, was a Federalist. He wanted essentially a large, powerful government that was different than King George, but he still wanted a large, powerful central government. Thomas Jefferson, who worked with him, who's the founder of the University of Virginia, the third president, and wrote the Declaration of Independence, was an anti-federalist. He wanted the power vested in the states. This Roe versus Wade, which was voted on by 7 justices, 7-2, in January of 1973, basically said, we're going to just blow off the 10th Amendment, and we're going to give the power to the federal government. What this decision does by a conservative majority is put the decision back to the individual states. All right? That's probably what's going to happen. We've already seen the leak, unless somebody gets to Brett Kavanaugh, who is the swing vote here. It's going to come out and be law. But you must realize that this does not ban abortion. So if you're pro-life and think, oh, no more abortions, that's not true. And if you're pro-choice and think, all is lost, we can't ever get abortions, that's not true either. Now, if you live in a state that makes the decision against having abortions, you may have to go to another state. And I don't know what to tell you about that. I left Illinois for a lot of reasons. This is one of them. I made the decision to move to another state. Okay? But this is basically a federal versus anti-federal issue. And there are many of them. This is just one of them. Okay? All right. Several people have asked me, why is it so important that Elon Musk is going to buy Twitter? And why would he do this? This is his little stick drawing. Okay? So if you look at the top, there's his liberal friend. There is he, left of center in 2008. And there's his conservative friends. In 2012, his liberal friend darts to the far left. or more far left. Okay. And that, he's still sitting there left of center in the conservatives where he is. And now his friend in 2021 is out there, a woke progressive. These are not my words, folks. This is Elon Musk. And because the line has stretched, that puts Elon Musk right of center. That is why Elon Musk is A, a genius, and B, is buying Twitter. All right? Because he believes that the best thing for America is to have free speech from both sides of the aisle. That's your answer for those of you that ask. Rasmussen polls, probably the best at predicting American political behavior, shows Biden at 38%, 61% disapprove, 20% strongly approve, 57% strongly disapprove, gives him an approval rating of minus 37, which is lower than Jimmy Carter's. All right. It's kind of astounding. Why is that happening? It's the economy. It's the economy. It's not even the border. You can think whatever you want about the border. You can think whatever you want about Roe versus Wade. It's the economy. It's killing the people because they're not able to spend discretionary income. We Americans love to spend discretionary income. All right. The red states are where gasoline is most expensive. What a shock. Most of them are blue except for Arizona. And even they have high taxes. Alaska has among the highest taxes in the country because of their location. Okay, so you're looking at $7 plus for a gallon of gas. All right. And then you have the Biden administration scrapping plans for 3 offshore oil and gas lease sales. Just Tuesday, this was announced. Okay, these are things that are happening at the federal level that will affect your pocketbook, and that's why I have to mention them. I'm sorry if it rubs you the wrong way politically, but this is something I have to report as your money manager, okay? And so President Biden goes on TV on Tuesday, and he blames higher prices on COVID and Putin. Okay, if you think about it, that's really not fair to COVID, and it's not fair to Vlad, all right? So COVID shut the economy down completely in April 2020. By the way, remember the market low was March 23rd, right? 2020, already mentioned that. Okay, so the market already figured it out and was starting to correct. But the economy shut down in April 2020. President Trump had an inflation level of 1.4%, and it stayed there. It stayed there through the end of Trump's term. When Trump left office, a gallon of gas averaged $2.93. A year after President Biden, gas costs $3.95, and you guys have been putting in the chat over there what it is now, and I told you what it was in Tennessee. This is why people are upset, okay? 2,000 Mules. I'm just telling you this. If you don't know about it, I would suggest you check it out. 2000mules.com. This is a Dinesh D'Souza movie. If you're on the right, you probably are cheering it. If you're on the left, maybe you're scratching your head. I don't know. But this is one of the best explorations of how votes are tallied in America. This election in 2020 was won in 5 cities in America. I'll let you watch the movie to see which those 5 cities are. But it's astounding to me the razor's edge that this country is operating on now. That's how close we are on this blue state, red state, left, right American. Okay. Pretty educational. I think you can find it for free. All right. And this from Ronald Reagan. When a Republican president is elected, I hear all the lefties in Hollywood saying, oh, we're going to leave. We're going to Canada. We're going to Mexico. I'll never stay here. And then when Trump's elected, they do the same thing. When Biden's elected, all the far right conservatives, oh, I'm leaving. I'm going to move to Alabama or wherever they say. This is what Ronald Reagan said. If we lose our freedom here, there is no place to go. No place to go. This is the last stand on earth. Remember that, okay? All right. When we vote in November, for sure. So, economic indicators, not a whole lot going on here. I mean, obviously there is, but I've had long sections earlier. This is showing you the change of spending for essentials and less on fun stuff. So you see more on gas, car insurance, personal care products, housing, and way less on furniture, airfare, recreation, alcohol, boohoo, alcohol. But yeah, it's just, we're still spending money. We're just spending it more on staples than discretionary. And yet consumers are resilient. See the red line? It's still going higher. People are still not afraid to spend money, but they're changing their pattern to more things that they need than they want. The longer this goes on, the more likely we could head to a recession. I think it's temporary. Believe me, I'm watching it, okay? But we're still spending as Americans. Part of the reason, look at the job openings. I mentioned this earlier. We had a survey that there were going to be 11,200,000 jobs. The actual number that came in for March, this is actually a 2-week-old data now, 11,549,000. So just top of the chart here. Plenty of job openings. You saw from the recession band, jobs going down like 5 slides ago. Okay, we're not going to have a recession with this many job openings because anybody that wants to work can work. Anybody that wants to work can find a job. The grass is greener, though, for job switchers. See that red line? And again, I know this for a fact from within my family. Okay, it's a great time. If you have a skill set, you're willing to work hard, you're willing to be diligent and be in an area that's in demand. And if you're not, then get there. Okay, but people that are switching jobs, especially that are going to mega cap stock companies, are seeing significant raises, almost astounding raises, percentage change. So when you have this kind of market behavior going on, and I don't mean stock market, I mean employment market, we're not near a recession, guys. Okay, so here's my tip. Blowing on the wine in your mug, okay, I don't know, where's my mug here, will help convince your Zoom meeting that your tea is hot. Okay, there you go. So the Fed, here we are. The stock market in its coffin. The pallbearers are Jay Powell and, of course, Janet Reno, who herself used to be the Fed chairman, and President Biden, and there's even Vlad. They're all carrying the stock market to the grave. No, not going to work that way. These 4 people are not that strong. What determines the success of the stock market over decades is earnings and interest rates. And yes, interest rates are moving up. Are they historically high? No. Are they historically average? No. We're not there yet. In a year, could we be? It's possible. I don't see it. But come back and see next month. Okay. All right. The market basically fluctuates when the Fed starts tightening. So that yellow line you see is where markets are tightening. So this is looking back over different time periods where the Federal Reserve is tightened: 1994, 99, 2004, 2016. And you can see the dip down there, if you can lean in and see the gray lines, is about what the other markets have done. Now, then they take off. Well, we'll see if this market takes off. Are we near the bottom? We are pretty close to historically a pullback. And that's why I'm not concerned, because I am seeing seller exhaustion. What does that mean? We're running out of sellers. We're looking around and there's still some, but not nearly as many as there were 2 months ago. Okay. So historically, we're where we need to be. The S&P finds its bottom within 1 to 2 months after the initial rate hike, which was last month. Okay. Now, Fed hiking cycles. Does this mean we're heading into a recession? How many months before we have a recession? Okay. 20, 25, 20, 37, only 11. So the shortest gap between 80 and 81, it took 11 months for a recession to start. We're not going to start a recession in 11 months if we continue to have so many job openings. Okay, it's just tied to employment. If people are falling all over each other looking for, I should say employers are trying to find enough workers, that's just not how recessions start. It's just not. Okay, the typical gap is 27 to 23 months. Look at the bottom. 2 years, basically, an average of those two. All right, so we're a ways off. Okay, stocks tend to do just fine during periods of Fed hiking. You will not see this chart on the news programs. Okay, look at all the green. Yes, I can see 1972, 74 was red, as was 83, 84, and 87, 89. Okay, but those are small numbers with the exception of 72. Again, we work in probabilities as a money manager. I'm not going to trade my clients' portfolios based on data going back to 1946, based on one aberration in 1972, 74, that period. Okay, stocks are going to be fine once they find that bottom, right? Let me go back 2 slides. We're looking for this bottom. That's what the market is searching for right now that the first rate hike has happened, and we're virtually certain there's going to be a 50 basis point hike in June. Okay. Housing, this is, it just continues to be a great story. Inventory of unsold houses continues to drop. Tiny uptick there, but not really much. Look at this home appreciation. So if you own a home and you're in the market, at least you can look on Zillow or whatever source you use to value your home. And you should be thinking, okay, so I got some assets that are down. I got one that's, increasing. If you don't own a home, this is a tough time because your stocks are going down. Your crypto's for sure going down. I didn't even do a crypto section tonight. I realized I couldn't get through it without crying. So, but your home appreciation, this is a good time. This is a really good time, and it's actually benefiting some from this inflation. Wouldn't it be great if we could have inflation on our homes without having inflation on our food and cars and everything else? We'll figure that out someday. Not. Okay. New homes under construction. I had a lunch in downtown Nashville with a client that came down from Chicago, and I got out of my car and parked, and I saw 1 or 2 cranes. Then I said, I'm just going to spin around here. So I turned around. I can't do it here in my studio, but 360 degrees, there were 9 cranes from the place I was standing in Nashville. 9 cranes. I mean, they're just building. And these are high rises, and we're still seeing the same thing out in the suburbs. I bet it's that way where you are too. So the buying demand index has flattened out from last year. But I don't see that as a problem because inventory is dried up. It's a good thing. I mean, if we just see price stabilization, honest to goodness, for what my house is worth right now, which is like 50%, 51% higher than what I paid for it, if it just flatlines the rest of the year, I'm fine with that. Let it breathe a little bit, okay? Same thing with the stock market, getting back to neutral. 30-year fixed rate. So this is a decision for those of you that are getting in the market. You don't have to go with a 30-year fixed rate. You can do an ARM. In fact, when interest rates were 6 to 7%, I didn't have a fixed rate mortgage until 4 years ago. Okay. And I still have one because I got it at 2 5/8 or 2.625 for those of you that like decimals. Okay. But there's nothing wrong with an ARM. Now, could inflation be 14% when that ARM runs out? It could. It's highly unlikely. That's not the probabilities, okay? So because of fixed rate mortgages, you are seeing mortgage payments higher, all right? And that's going to stay unless the Fed starts making the decision to, okay, we've raised enough to match the inflation rate. Okay, it'll take increases through the end of this year to do that, but not into next year. And you'll start to see, I think, this whole mortgage payment leveling out, especially if people opt to do ARMs. Okay, annual renewable, mortgage rate. So anyway, guys, that's where we are. I'm gonna look in the chat here, get one more sip here. The Endless Enigma market review indicators. Inflation's definitely what's on people's minds. COVID's ebbing. U.S. policy, I hope it didn't rankle you guys, but that's the way I see it. I try to spin it, or I should say present it in a way that helps you understand what's happening at the federal level, at the administrative level, the presidency, and Congress. That's affecting your portfolio, okay? Economic indicators, the Fed. I told you I wouldn't do crypto because it made me cry. Housing market's still strong and it's helpful. So let me look at the chat here. Okay. Putin selling oil to China and India for $30 below world price. I didn't know that. Hussein. Yeah, it doesn't surprise me at all. It doesn't surprise me. I mean, they're desperate. These sanctions, he's never going to get on camera and sanctions are hurting me. He's not going to do that. First of all, 90% of what he says is a lie anyway, so you can't count any of this. But yeah, I'm with you on that. Definitely like your explanation on the recency bias. Yeah, but it seems like we're about to fall off the cliff with the current administration's policies. You know, in the political section here, I say it just as much as I can. I understand that most Americans don't like Donald Trump. And I get it. I would rather have mean tweets and a narcissist in the White House with policies that help me as an American. Because what's happening now with inflation at the border, certainly foreign policy, you didn't see Putin doing any of this stuff when Trump was there. I mean, for me, it's about leadership. I don't have to like my president. I don't even have to like my mayor. I just want a safe place to live. Okay? That's maybe. Thanks, Dr. J. I agree that Reagan had a great point. He was a brilliant, brilliant president. 2,000 Mules, excellent. So Martha must have seen it. Why does your lighting look better? I'll mention that my producer in Chicago, Tom Brown of Innova Digital, came down and did some tweaking in my studio. You know, I'm an audio kind of guy. I got the lights going, so I'm hoping I look better tonight. There's only so much you can do to improve my looks, but thank you, Thomas, for coming down, working on the studio there and doing some more headshots. Guys, I think that's about it. Next show, Thursday, June 9th. Don't want to miss it, you know, every single time. I got one for you here, just a little different. Rich people play the money game to win. Poor people play the money game to not lose. Now, notice I'm not picking on people that are rich or poor. I'm just saying the mindset, if you want to win, is if you're going to be someone that is fearful, you're probably going to opt to just not lose. And that's not going to grow your assets. As much as I love my parents, they were not poor, but they did not increase their wealth because they kept their money in CDs and bank accounts, even when they were paying 7 and 8% their whole lives. Okay? There's a book by Robert Kiyosaki, Rich Dad, Poor Dad. If you want to read that, it's really, really excellent on that issue. So there you go. As I always finish every program, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. So guys, every time I start this program, I'm so grateful to you that watch. Tell your friends. Sometimes we have 20, 30 people live, and then 100 or so, over the course of the month following the data. The whole reason I exist on this program is to give you information from, as I said, 23, 24 sources. It's the information I use to invest on your behalf in your accounts. It's the same investing I'm doing for myself. You guys trade with my family house, okay? So tell your friends, tell them to turn off the news. This is the hard data. Everything I do is double sourced. You can check the sourcing at the bottom of the slides when you play it back. And it's the information that the corporate media doesn't want you to know because, again, they want your eyeballs. I want your peace of mind because as an educator, that's what I need. And as your portfolio manager, that's what's in your best interest. So you guys have a great rest of the month here and into June. It's going to be an interesting summer for sure. Election in November. If you got questions, CB3@cb3.com or my number's on the screen. God bless you. We'll see you next time.